Hello, my name is Carl Mandy and I'm the Tax Technical Partner and Tax Policy Leader for PWC South Africa. It's my privilege to provide you with an overview of the tax landscape and what you can expect from our annual tax update. 2017 has been a very busy and eventful year from a tax perspective. The economy entered a technical recession in the first quarter of the year and exited this in the second quarter. However, the economy continues to struggle, with growth for the year forecast at just 0.7%. The poor state of the economy has partially contributed to the projected tax shortfall of 50.8 billion rand against the February estimate, although it's clear that a large portion of the shortfall is due to declining levels of tax compliance, tax morality and administrative performance by SARS. To add to the pressure on the fiscus, by the time you read this, S&P and Moody's may have downgraded South Africa's local currency credit rating to junk. Taxpayers started the year with a shock, as tax increases of 28 billion rand were announced in the budget, most of this coming in the form of personal income tax, including an increase of the maximum marginal rate to 45%. The dividends tax rate was increased to 20%, and above inflation increases in the general fuel levy and sin taxes were introduced. Significant developments have also taken place in relation to tax administration. The Special Voluntary Disclosure Programme for undeclared foreign income and assets has now come to an end and apparently resulted in 1 billion rand of additional revenues. On a related note, the first exchange of financial account information under the Common Reporting Standard took place in September. The first country-by-country reports for multinational entities are due at the end of the year, and the requirements for transfer pricing documentation, master files and local files have been finalised. The Tax Ombud also finalised his investigation into delays in the payment of refunds by SARS. Then of course came the surprise announcement that a Judicial Commission of Inquiry into the tax administration and governance of SARS is to be established. The primary motivation for this inquiry is seemingly the poor revenue collection performance by SARS. In the tax policy arena, the Davis Tax Committee is close to wrapping up its work and recently issued a number of final reports. Finally, the tax amendment bills for the year were tabled in Parliament in October. There weren't too many major changes, but a number of them are far-reaching. Perhaps the most controversial of all, and certainly the proposal that solicited the most emotive response, was the proposal to repeal the foreign employment income exemption. Other significant changes include the refinement of the debt reduction rules, anti-avoidance rules to address dividend stripping associated with share disposals, and the expansion of the definition of a controlled foreign company to broaden the ambit of this legislation. You may even be surprised to learn that you'll be paying VAT on some brown bread in the future. I hope that you find the tax update informative and of benefit. We thank you for your support and invite you to reach out to us with any comments and suggestions on how we can make the annual tax update even better.